All right. Well, good afternoon, everyone. I'm so excited to have you all here. This is our monthly class called A Realtor's Time. So I do hope that you are able to invite all your realtors and business partners. And if you're joining us for the first time today, welcome. Say hello to us in the chat so that we know that you're here and we can say hello to you and welcome you here. My name is Cher. I'm the Director of Student Services for 2020 Vision Coaching and Consulting. And today we have back Christina.Harmes Hika, which I'm super excited about. We had such an amazing class with her 2 months ago, and she's come back again today to give us a follow-up. And today's class is called Wait, You Can Buy a House with Reverse Mortgage Purchase Loan. Christina, thank you so much for being with us today. I'm excited to have you here, and I'm going to let you go ahead and take it on from here.
Thanks so much, Cher. I'm excited to be here with you guys. It looks like there's a lot of loan officers and realtors in here, so really good mix. That's awesome. I'm going to go ahead and start sharing my screen and just dive into it. I may ask you guys to hold questions to the end, or rather, not hold questions. Please type in your questions. I may answer them real time. I may wait till the end. So as they come up, just type them in and know that I'm not ignoring them. I'll just get them towards the end. All right, so let's dive in. All right, so this is what? You can buy a house with a reverse mortgage loan? How's that possible? So you guys have a huge advantage for being here today. So thank you so much. And your clients will thank you, your business will thank you. This is almost a secret loan, not for lack of trying. I'm trying to spread the word every which way I can, but it was a loan created in 2009. Before 2009, you could not buy a home with a reverse mortgage. You would have to buy it with some other type of financing or cash and then refinance into a reverse. Well, eventually in 2009, they said, okay, we're making people pay double closing costs. Why are we doing that? So they revamped it. So they added this option. You can actually buy a new home with a reverse mortgage. Now that saves your clients closing costs, but it also does a whole lot more for your business. You're going to be able to help people learn that they can actually sell when they didn't think they could. Typically, that's not having enough equity. This is a loan meant for borrowers over the age of either 55, 60, or 62, depending on the product. And so you're going to help them see, okay, you may not have enough equity to sell and buy in cash, and your goal is to not have a mortgage payment, but let's look at this reverse mortgage purchase option. We can do the same thing without as much cash and still achieve your goal of having no mortgage payment. So let's dive in. All right, before we get started, reverse mortgages have a bad rap or just an unknown rap. It's a very niche product. And so what I want to point out to you before we get started is that the consumer satisfaction is really high for people who actually have a reverse mortgage. And so you can see here, AARP, which is like a big senior advocate, and NMLS, the National Reverse Mortgage Lenders Association, they did a joint study and they surveyed borrowers and non-borrowers together. 9 out of 10 homeowners said they were satisfied with their experience with their lenders. 9 out of 10. That's huge. Ratings from borrowers were higher than those from non-borrowers. So what we're seeing here is that out in the marketplace, people who don't have reverse mortgages think they're not great. They don't really understand them. They're confused by them. They don't really get it. And so their satisfaction ratings show that. Borrowers, though, 93%. That's pretty incredible. That's a very high satisfaction rating. So when you're out there talking to people, if you hear someone say, oh, reverse mortgage, it's not great, I don't like those, whatever, you may want to state this and say, you know what, interestingly enough, it's a really misunderstood product. But among people who have a reverse, 93% were either highly satisfied or satisfied. You can use this chart if you want to take a screenshot. By all means, this is kind of data. I don't know if you guys actually want to be showing this to your clients, but this is where it comes from. So we have borrowers and non-borrowers, and you can see the percentages. So either they answered very satisfied or somewhat satisfied, and that's 93%. That's huge. All right, I'm Christina.Harmes Hika. I'm evangelical about reverse mortgages. I love them. I started my dad's office when I was 16, so I've been in this industry for quite some time. I've been a top producer of just reverse mortgages for years. I'm a national speaker on the topic. I've mentored hundreds of loan officers to learn reverse specifically and succeed in reverse. I've helped develop and build the reverse division of C2 Financial Corp for years, from its infancy to not where it is today, but a few years later. I'm a CRMP. So this little pin designates Certified Reverse Mortgage Professional. It's the highest designation in the industry, and there's only about 200 of us nationally. Personally, I love surfing. I was a surf coach forever. And I was a surf coach for an all-girls high school. We brought the team from 8 girls all the way up to 42 girls when I finally bowed out and I had my child last year. And then because of this, I love reverse mortgages. I love coaching. I have just launched a reverse mortgage coaching company. So it's just reverse. That's all I focus on. It is a very niche product. There's a lot of intricacies. And so the coaching business has been taking off. It's a really good time for it. So let's talk about the opportunity. The opportunity is gigantic. Everybody talks about millennials, which is a huge part of the population. But the problem with the millennials is that they do not currently own homes for the most part. These are our new buyers. So your realtors, you guys as realtors, are not getting a listing when you work with millennials. A lot of the time, you're just getting that purchase. Well, check out the chart here. Boomers are almost as big of a portion of the population. You add in boomers plus the matures, and now we're talking larger than the millennials in population. The cool thing about this is that these people have owned homes. These are going to be your listings and your new purchases. So you're going to get 2 deals by working with seniors in this space rather than anyone else who doesn't currently own a home, and maybe the new buyers are the focus. I think new always sounds so great, but the truth is here, older homeowners have a huge opportunity for your business, and most people ignore it. It is so sad to me to know how many realtors have no idea about this loan, or they just don't stick around long enough to understand it to implement into their practice. That's where the opportunity is for you. Stick around long enough to implement it into your practice. Work with the loan officer that has brought you to this class today to actually understand this loan and help your clients take advantage of it. There are a few realtors, I probably list on a few hands how many I know that really specialize in this, and they dominate the market because they're the only one who understands how it works. Interestingly enough, 80% of boomers are homeowners, and 25% of home buyers are age 60 plus. That's 1 in 4. It's a big opportunity there. The other thing that we often ignore in the conversation is how much housing wealth there really is at retirement. And this product can help your client free up some of that housing wealth to use for their retirement. So this is a stat from HomeBot. A lot of you guys are familiar with HomeBot. I'm a fan of theirs. They say that 83% of wealth at retirement age for the average American homeowner is tied up in home equity. That means they're trying to retire on 17%. Now, think of people in your life that are in retirement, probably with a lot of equity in their home. Are they struggling in other areas? We call that cash poor, house rich. Reverse mortgage purchase or a refinance, either way, they can help balance this out a little bit better. Our country has an agricultural history. And so what that means is that families would leave the house to the kids so that the kids would take care of the parents in their older years. Well, that's not really the society we live in anymore. People don't stay on the same property. So having a free and clear home to pass on to the next generation typically just results in equity, right? They're selling the home, they're getting the equity back. And so if we're just talking dollars and cents, why not balance that a little bit better so that you can have a nicer retirement? Now, 1/3 of baby boomers are actually going to relocate to a new state for their retirement. That's a lot of movement, you guys. That's a huge portion of the population. And you're seeing it on this map here. This is from CAR, actually. Before we dive into the details of doing these loans, I want you guys to know some of the really common myths. Myth 1, the lender will own the home. Not true. Just like any other mortgage, it's a lien against title. Your borrower will maintain full ownership, just like any other mortgage. Myth 2, the reverse mortgage requires monthly payments. I don't know where that one came from, probably because every other mortgage requires monthly payments, but that's not true at all. With the reverse, you don't have to make monthly payments. Instead, the interest accrues onto the loan amount and it's paid off at a maturity event. Typically, that's when the last borrower passes away, moves out of the home permanently, or sells the home. So we have events which help protect against longevity. These people can live in their home till they're 110, 115. There's no end term like there are on other mortgages. Instead, the mortgages do at an event. All right, the reverse mortgage must be paid back after 30 years or when the borrower turns 100. The 30-year thing, that is a misconception from the forward world because a lot of the forward mortgages are 30 years. The reverse doesn't have a term. And then when the borrower turns 100, that misconception is because our presentation ends at age 99 for every borrower. So you just need to make sure you clarify with your clients, like, we have to end the numbers at some point, and this is where they end for everyone. But that doesn't mean the reverse actually stops. It does not. Myth number 4, to qualify, the house must be debt-free and paid off or free or clear. Not true at all. When the refinance process, we can pay off existing mortgages. The truth, we will pay off any other liens, a reverse wants to be the only lien on title in most situations, typically. So we will pay off any other liens too. If there's a judgment, if there's a second, maybe solar financing, anything like that, reverse wants to be the only loan. So when you're selling your homes, I don't know if there's states where the solar can be transferred. In California, where I am, it can't be. So we're paying it off anyways. But in states where it can be, you want to look into that detail to see if that's going to cause a hiccup in your deal. And then with a reverse, they can't ever sell or refinance. That's not true at all. They can still refinance into any other kind of mortgage. They can still sell at any time. There's no prepayment penalties, so they're not stuck. And as we'll see later, they're not stuck without loan balance growing either. They have full control to make payments should they want to. And some people do. There's benefits to doing that. I don't have my question panel up, so let me pull that up in case anybody has any real-time questions I want to glance at. All right, cool. We're good. All right, so some strategies and scenarios. This is, if you don't already have your notepad and pen out, this is where I want you to write down your notes or start writing down your notes. The reverse purchase will give you more flexibility to offer to your clients, right? You likely have a client who has sat down with you to look at a sale of their home and a purchase of a new home, maybe one better suited for them. Maybe they have a 2-story and they want to move to a single story. Maybe they just want to move closer to family, or the house is just too big in general. In any case, you've probably had that session where someone tells you, oh, that's just not enough so that we can buy again. If they're over the age of 55, 60, or 62, depending on the program, this would be a really good option for you to bring up to them because you can create that listing where there wasn't going to be one before. Maybe it's that they couldn't actually qualify for a forward mortgage to buy that next house. Well, reverse qualifying is easier because I don't have to qualify to a certain monthly payment, right? We're making that monthly payment go away. So that means they need that much less income in order to qualify. So this is going to open up a lot of opportunity for you with your older homeowners. Buying a home that's best suited for them. We'll see a couple of examples. It's not always downsizing. Sometimes it's upsizing, but a lot of the time we call it right sizing, which doesn't really matter what the purchase price you're going from and to is, as long as the numbers work. It's more about the lifestyle and the ability to safely age in place in a property that's appropriate for that. You may have, I want you guys to think of your client base. You may know that senior who said, I really can't stay here. It's not safe. And you met with them and they just decided the numbers didn't work. So they're still in that unsafe home. Bring this opportunity back to them after this session today. You'll get that listing. You are going to change someone's life. In a different presentation, I actually talk about how aging in place is so important, and the reverse can create the foundation to be able to do that in a safe environment, because that person is going up and down those stairs every single day, or maybe it's a long driveway, maybe it's maintaining a pool, whatever it is. And that's a risk to their health and safety every single day they do that. So urgency a little bit on this. Bring this back to that client that's in your head you're thinking of. Really cool option. You can sell and buy 2 homes instead. Now, why would you want to do that? Well, what if you bought an investment property and now that investment property is paying you rent during your retirement years? I know a really big financial planner who tries to get every single one of his clients into that situation. Sell their main long-term home, buy a smaller one and an investment property. The smaller has the reverse on it, the other one doesn't. So now they're leaving two houses to their kids, and you're getting all of those transactions. That's 3 transactions. Working with a builder and considering new construction. So, interestingly enough, the state of Utah has really excelled in working with builders for this reverse purchase option. And what they found after years of doing this was that people would actually increase their purchase prices and add on extra amenities because they had the reverse mortgage paying so much of their down payment. Well, excuse me, financing so much of their purchase, their down payment had to be smaller. So they could actually go up in price. So when a builder actually, you take the time to educate them and they understand how this works, they love it. And most builders do not offer this kind of financing. So again, big opportunity, a big niche for you to be able to work with builders a little more easily and actually have them love you, not view you as a competition. Creating liquidity for other investments. We're going to get into one of my favorite examples where you can actually create a retirement account for someone using this loan. Buy a second home or investment property. Now, in that case, instead of selling their main home, they're just going to pull some money out from their existing home and go buy an investment property. And again, there you've got 2 appreciating assets, with one with the reverse, one without. Now, you may be able to buy that investment property for full cash, depending on how the numbers work. You may just be using that as a down payment and then put a different kind of mortgage on that investment property. In any case, you have just doubled their appreciation power because it's going from 1 home to 2. So really making retirement, and you've created a new purchase for yourself where they didn't see one before. So that's a really creative strategy I absolutely love. I've had a few clients who've done it, and it's amazing. I have a few clients who did a second home, a few clients who did an investment property, and quite a few clients who pulled out cash to help their kid buy a home. In any case, 2 properties, as we all agree, is better than 1, as long as we're in an appreciating market. Relocating closer to family. That's a big one. As we saw on that map, people are going to be moving states. A lot of that is to be nearer to family and grandkids. Maybe it's a weather-based decision or location-based decision, but there's a lot of movement in this section and people don't know about it. They don't see it. Move on from a later in life divorce. Later in life divorces, we call them gray divorces, and they are really, really on the uptick right now. They have been for years. People are just getting divorced much later in life, and that can be devastating financially. The reverse mortgage can help ease that because a lot of the time, people who are older in years have one single family marital home. They're selling that marital home and they're splitting the proceeds. And those proceeds typically aren't going to be enough to buy a new property similar to what they were used to. So we see people rent. Well, you bring in the reverse purchase and suddenly both spouses can go buy a home very similar to the one that they just left. That's huge. And now you've turned that one listing for a divorce into a listing and 2 purchases. This is real world stuff. I've seen this stuff happen. You guys can become the expert, become the niche product offering, and bring this to your business and bring this to your clients. All right, I want to go to a simple example. This is Sue. This is not her actual picture or her name. I have to change that for privacy, but this was a real client of mine. So her whole goal was to move closer to grandkids. And I'm going to go through this quickly because I'm long-winded and there's a lot to content. So Sue sold her home in Northern California. After everything was said and done, she netted $900,000. Now, she wanted to move to Southern California to buy a condo near her kids and grandkids. And the purchase price on the condo she found was $600,000. So Sue was very excited and just content with, great, I'm going to be able to keep $300,000. That's more than she had anywhere else. She was a widow. She had had big medical bills when her husband passed away, and that took everything they had except for the house. So to Sue, $300,000 was great. But to the kids, they realized, well, Sue was only like 68. she wasn't that old and she was in really good health. And they were realizing that 300,000 is not really going to get you that far, mom. So why don't we look into a reverse purchase instead? And this worked out beautifully. Instead of Sue putting 600,000 cash down, she used the reverse purchase that funded about 50% of the purchase. So now, instead of sinking 600,000 into the property, she only sunk 300,000 into that property. The reverse covered the rest, and she kept $600,000 cash. Now, through this process, we had to keep reminding her that she would need a financial planner. We would say something to the effect of, well, that financial planner is going to make sure you're putting this in a safe place where it can still grow and it will last you the rest of your life, hopefully, if they do it right. And she kept saying, but I don't have a financial planner. And we had to keep reminding her, yes, but you're at the end of this transaction, you're going to have $600,000 cash. You better go get one. So that was just amazing for her and her family. She went from saving zero from retirement to 600,000. That is a huge leap. The power of this product is incredible. So you can actually help people create their retirement accounts. I have a different presentation I call the listing maker and the retirement maker. And the retirement maker is all about this situation where we are selling something with quite a bit of cash, buying something with less cash, and putting the rest in investments. Now, to help anyone who's not familiar with the senior marketplace, your senior clients are likely going to be a little resistant to moving, aside from the financials. Us young people always go, oh, the numbers work, let's do it. Well, there's a lot more to consider when you're in your 60s, 70s, 80s, and you've lived in this home for 20, 30 years. You want to bring up the idea of a senior move management company, and they will make the transition easier for your older clients. They may actually help you make the sale because a lot of people don't want to move. Even if the home's not suited for them, even if you've proven the financials don't work, they will still want to stay there because of the hassle of moving, but they may not talk about it. So you need to bring this up. Look in Google or ask for referrals for local senior move management companies that you can partner with to help make this easier for your clients. All right, quick question. Does anyone know if you have senior citizens for the first time home buyers, no money down, they could get a government loan and a reverse purchase? Sounds crazy to me, but might as well ask. So no, and we're going to get into that. The funds have to be their own funds for their portion, or they can be a gift fund, but it cannot be borrowed funds. So that's a really creative way to think about it. But unfortunately, that wouldn't work because you'd be borrowing the government loan for the down payment and then doing the reverse purchase. Would be two loans, and that's not going to be compatible. All right. So why the HECM for purchase? Well, let's talk about some safeguards. People think reverse mortgages are risky, but in truth, there's a lot of hoops everybody has to jump through to get one of these in place. And that's because seniors are a protected class. So there's extra safeguards built into this loan that are little known about. Safeguards. A few are there's counseling. Nobody can move forward with a reverse mortgage without having gone through and passed a counseling session with a third-party HUD counselor. Sometimes you will have two appraisals. If the first appraisal comes in and FHA flags it, you may have a second appraisal. So that's a safeguard to make sure that we're not lending more than is realistic to expect for that property value. The loan is non-recourse. For those of you who don't know what that means, it means that FHA has mortgage insurance on this, and that provides for the loan to be non-recourse. It's very rare, but it can happen. When the loan balance, if somebody's had a reverse for 30, 40 years, and or interest rates have skyrocketed, or during a down market. That's the most common one. We saw this in 2008, where people had a loan balance higher than the market value of the property, and they passed away at that point in time. The FHA insurance picks up the difference because this is a non-recourse loan. They cannot look to heirs, they cannot look to the estate, they only look to the property. So in the situation where you're creating another investment property, that other property is not affected by what's going on with the reverse mortgage. And it's a nice way to hedge assets and leaving inheritance to their kids, because now you have one home with the reverse. So there's a little risk you may need to use that non-recourse option and the equity would be used, but you have a second property that is not in that same situation. Likely it's free and clear, or the mortgage has been being paid down by the rental income. It is FHA insured. Not every reverse mortgage is, but the main one we talk about is the FHA HECM, and that one is FHA insured. There are other types. So when I talk about different ages, there's different reverse mortgage programs. They're not all FHA, and some that are not will go down to the age of 55 plus, depending on the state, depending on the situation. No monthly mortgage payment, no required monthly mortgage payment. They can make monthly payments if they'd like to. It will preserve capital and equity, as we just saw with Sue's situation. They're flexible, no prepayment penalty, and it's a non-recourse loan. Additional benefits, you can live in the home for the rest of your life. This is a nice way to protect against longevity. You still own the home, so you still continue to have equity. And as we'll see, we have a slide near the end, so stick around. As we'll see, we project that out. And most of my clients, now I'm in California, so it makes it easier because we have great appreciation, but most of my clients will have increasing appreciation while they have the reverse mortgage. Increasing appreciation. I want you to hear that, because most people think that when you do a reverse mortgage or reverse purchase, that because that interest does accrue, that eats into your equity. But equity is not a stagnant figure. We are not just stuck at the property value that we have today. That property value increases because the appreciation is on the full value of the property. That typically increases much faster than the interest, which is on a portion, just the loan amount. And we don't loan near the full amount. As someone mentioned in the comments, it's about 50%. So think of, even if the interest rate is, 4 or 5 or 6, on that smaller portion, it's still growing much more slowly than the appreciation on the entire home's value. So that's a big misconception. I would love for you guys to be able to internalize that and repeat that back to your clients, because it's a huge misconception. And that's where that 93% satisfaction rating comes from, because we're protecting them now, protecting them through retirement, their cash flow and their cash needs. And then at the end, they still have increased appreciation. So they're getting more than they would have if they sold today. As you can tell, I'm really excited about it. That's a really good loan. Additional benefits. We actually don't have to have FICO scores on refinances for a reverse purchase loan. We need a score to show up. However, it doesn't matter what the score is. Now, we do look at credit history. So there are some markers that will be looked at. Have they been late on mortgage payments? Have they been late on property taxes, homeowners insurance? Do they have really derogatory credit? We'll check for all of that. That is part of qualifying, but the actual score itself doesn't matter. So if you have that client who, their score was in the 500s and they just couldn't buy, bring this to them if they're old enough. Limited income is okay. As I mentioned, with reverse, because we're not qualifying to a monthly mortgage payment, it's much easier to qualify. There's also some what I call magic tricks. So in the forward world, you often have to prove that income will come in. In the reverse world, often we can dissipate assets without actually having to make the client take those assets yet as a monthly amount. So that makes qualifying a lot easier, because some people don't want to touch their assets. They don't have to with the reverse purchase. All right, we have questions. All right. So most reverse mortgages need about 50% down equity. That is a general rule, but that's not quite how it's not straightforward like that. So we're going to get into numbers too. And then we say, wait, so we do 40% and 60% another loan type. No other loan types on these properties. Reverse has to be the only loan. The portion that they are bringing for their down payment has to come from them, and it's cash or a gift of equity. Excuse me, not a gift of equity, gift funds. So like if their child wanted to give them some money, you could do it that way, but it cannot be borrowed funds for their portion of the down payment. All right, how does the HECM work for new construction? Not my favorite topic. Does the new construction need to be FHA approved? I assume the house must be ready for FHA appraisal. So yes, the house needs to be ready for FHA approval. And an appraisal that is mostly complete. You need a certificate of occupancy issued prior to closing. And actually, I'm going to stop because we have a slide on that. So hang tight. We're going to get to that part. The FHA insurance, people often are like, oh, I don't like FHA insurance. But the truth is, it allows the program to exist, period. So it is a price paid for a lot of the protections. The insurance protects the borrower on a reverse much more than they do on the forward side. It allows for us to have real interest rates competitive with a forward space. In general, I say our interest rates are about half a point more than a 30-year fixed. They're not that much higher. Now, there are options with higher rates if people want more money, but they don't have to take that option. And we do have really low, competitive lower rates. Actually did a reverse a couple years ago for 2.99. So rates are not as crazy as you might hear out there in the market. This protects the homeowner in case they live for a very long time. The oldest baby boomer is projected to be 119. So far in recorded history, the oldest person has been 112. To my knowledge, they didn't have a reverse, but man, would they have made out if they did. No liability to heirs or the estate for any deficiency. All right, we might have some questions. All right.
Can you see the chat or do you need me to read it?
No, I've got it. I'm just a little slow reader.
No, you're fine.
Okay. Tina asked, to clarify, does the house used for the reverse mortgage need to be paid off completely? Absolutely not. Most of the transactions we do pay off a mortgage that exists already and then replaces it with the reverse mortgage so they don't have any more payments. So it can be free and clear, absolutely. But as long as they have enough equity that mortgage we're paying off isn't too high, we can pay off that existing mortgage or other liens on the property. What happens if their equity finishes? I think we're going to get to an example of that. So even if, and this is what you're talking about, even if the balance of the mortgage is higher than the market value of the property, nothing happens if they're happy and living there, paying their property taxes, homeowners insurance, maintaining the property to FHA standards. As long as there's meeting those requirements the whole life of the loan, there's no end to this. It doesn't matter that the market value of the property is less than the loan balance. If we structure one with a line of credit, now that's a different presentation, but reverse can have a line of credit on it. A reverse purchase can do that as well. Even if that line of credit were to grow over time to be higher than the market value, that line of credit is still available. They don't freeze it because of that. It is, and there's no term on that line of credit. Most line of credits have 10 years. This doesn't. Absolutely beautiful option. Too much content for this presentation. Most purchases are done on fixed rates, which don't offer a line of credit option, but the adjustable rates do. And actually in this market right now, most purchases are being done on an adjustable rate because there's some caveats that you should ask your loan officer about. It's too detailed to go into on this presentation. But just know there are two different types, and 90% of all reverse mortgages done are actually adjustable rate mortgages because there's significant advantages to it. So the LTV you need is around 50%, but the truth is it goes up per age. So right now, our interest rates just increased, which means that the amount the lender is willing to lend went down, or the LTV. It pegs up a little less than 1% per age. So if you're 62, you're not going to be able to get as much money as somebody who is 72. Or for the purchase, if you're 62, you're going to have to bring in a little more of your own money than somebody who is 72. Somebody who's 72 on a purchase would have to bring in a little more of their own money than somebody who's 82. So it's not linear, but it does increase by age. So somebody who's 62 just can't access as much loan amount as someone who's older. Now, the biggest thing that actually affects that is interest rates. So don't think, oh, I'll just wait till I'm older. It doesn't have that big of an impact. Interest rates do, though. So as interest rates go up, our loan amounts come down at every age. So right now, interest rates did just spike a bit. And so we're seeing that people have to bring more cash to close for a purchase than they would have if they did this a year ago. And if rates come down, that will change again. So just know if your client's getting quoted or you're quoting for your client, that those numbers are not fixed in stone, but clients get that in their head. They think, oh, great, I could purchase a $600,000 home with, $350,000 down, and I'll just keep that information in my head and do it when I'm ready. Well, when they're ready, you need to rerun the numbers because likely they've changed a lot. All right, owner occupied for the life of the loan. At least one borrower has to live there for 6 months plus 1 day of every year. That 1 to 4 units may qualify as long as the homeowner lives in one of the units. No manufactured homes on any purchases, but we can refinance some. Some condos will qualify. And someone had asked in the questions about FHA approval. So for an SFR, you don't need FHA approval. If it's a condo, you do need FHA approval. And there are two types. The whole condo complex can be approved, and I'm sure most of you are familiar with that process. And there's what we call single approval units, a single unit approval, SUA. And that process is a little bit harder. So on the forward FHA side, I believe the single units are kind of easier to get. On the reverse side, they're not as easy to get. Sometimes it's actually easier to just get the whole complex approved rather than that single unit, but know that it is an option. Now, most reverse mortgages we talk about is the FHA HECM. There is a cap on value for that loan. However, it's not the only reverse out there. There are other reverses that will go up to loan amounts of $4 million. The largest reverse I've ever done was on a property that was worth $15 million. So reverse is appropriate for a lot of different demographics. And now I can hear somebody's comment. I don't know who I'm hearing in my head, but I'm hearing somebody going, why is somebody doing a reverse on a property that's worth 15 million? Because it's a really good financial tool. And when you understand how it works, especially with that line of credit I mentioned, oh my gosh, it's just incredible. And truly, to purchase a house, you can increase your purchase power so far. So imagine if Sue had instead wanted to buy a much nicer home in a much nicer location. She could have doubled what she could think she could do, right? If she wanted to put 600,000 down, she could have bought a home close to 1.2 million. She didn't do it that way. Now, that's not the situation Sue wanted for herself. However, can you imagine increasing your client's purchase price from 600,000 to 1.2 million? They would probably be pretty happy without incurring a new mortgage payment. Most of the time when you're showing that situation, you're showing a doubled mortgage payment. With a reverse purchase, there's still no mortgage payment, even if it's one of the other options of reverse, not FHA. We must account for all spouses. Now, I think that there's a question about spouses in the chat, so I'm going to read that now. Ken asks, if one spouse passes away, can the surviving spouse continue to live in the property until sold or that spouse passes away? Yes, with an asterisk. If both spouses are put on as borrowers, which I highly recommend, if you can, if both borrowers are over the age and live in the home and are married, they can both be borrowers. And when one passes, nothing happens for the other one. The mortgage continues on just fine. So that's my favorite situation. That's the situation I put most of my clients in. Every now and then we will have a spouse that is under the qualifying age. And that is likely what you're asking about. Those are called non-borrowing spouses. And when that borrower passes away, that non-borrowing spouse must ask for a deferral. And there's some paperwork to get it. If they get granted the deferral, then they don't have to pay back the reverse mortgage until that non-borrowing spouse, moves out of the home permanently, sells the home, passes away, or defaults on the requirements of, owner occupied and paying property charges. So that is a really big protection. That protection was brought in 2014. So if you've heard situations where, the husband died and then the mortgage was due on the wife, that was a terrible black eye in the industry for years prior to 2014. That cannot be done that way anymore. We have to account for all spouses. And it's just a much better structure. It's much safer. It makes me believe in the product a whole lot more because we're not having so much risk out there. You guys all just saw many people go into forbearance. We're all familiar with what forbearance was and how it worked. And now the rest of the population is familiar with it. If you talked about forbearance to your client in 2019, they probably would have been like, what are you talking about? If you talked about a forbearance to your client today, they're going to go, oh yeah, I did it for 6 months. I didn't have to make a mortgage payment. I just pay it back at the end, or they just added it on to the loan at the end. Well, that's what a reverse is. So suddenly now we have a point of reference that people understand. We can talk about it and say, well, you know how deferral worked. You had a deferred payment. Same thing with reverse. Now you have the option to, of course, make those payments if you want to, but you don't have to. You can let it just add to the end of the loan and pay it back when the property sells, when you pass away, or move out of the home permanently. So relate that to forbearance because it will help your clients understand it a lot better. Here we go. Pay the loan back when the lost borrower or eligible non-borrowing spouse. There is a category of ineligible non-borrowing spouse. That's pretty detailed. I'm not going to get into it here, but coordinate with your loan officer if you have a situation and there might be a spouse who doesn't live in the home or has something different going on. But when the last one passes away, moves out of the home permanently, the home is sold, or the borrower defaults on their property taxes, homeowners insurance, maintenance requirements, or any HOA or other property charges, which, by the way, if you don't pay your property taxes on a regular mortgage or your homeowner's insurance on a regular mortgage, same thing. There's a couple extras, right? This is meant for a primary home for the entire time they have it. Unlike other mortgages where you can be owner occupied at the time you get the mortgage and then move out and keep that mortgage, the reverse must be paid back if you were to move out. Let me take a sip of water. Any questions? I'm going to take a minute here. All right, let's keep going. Oh, there's one. Payment is deferred, but taxes will need to be paid. Correct. One of the requirements is that they pay their property taxes and homeowners insurance directly themselves. There is a structure to have the mortgage pay it, but there's some drawbacks to that structure. So it's not a very common way we actually do it. Most times people are paying their own taxes and insurance. All right, reverse purchase process. This is where you need to write down or maybe take a screenshot of this. This is important when you're actually doing a loan and writing up the contract. You need to make sure you're including the signed FHA amendatory clause and real estate certification dated with the contract, not after. A lot of people do the contract date, then realize, oh, we need this stuff, and then get it signed later. You need it signed at the time the contract is signed. Contingency for home inspection. You can't waive that. You have to have a home inspection. Lead-based paint seller's disclosure, language that indicates that the seller is responsible for completing and paying for repairs that affect safety and security and soundness before closing. I'm sure you guys have been through the situation where there's some property deficiency and you can't finish the loan because of it. So that can happen in reverse. So you need to make sure that the seller is willing to if it's double strapping a water heater, putting in smoke detectors, there's a broken window, stuff like that. The seller needs to make sure they take care of that so you can close the loan. Any other real estate owned addendum you need to include seller concessions, incentives, or down payment assistance from any interested parties not permitted. It's FHA. The seller can pay costs that are common and customarily paid by the seller in that market. So realtor commissions, transfer tax, HOA fees. And you must the contract must state that there has been no value given to any real property. Any non-real property items. So refrigerator, window treatments, etc. A lot of the time you'll include stuff like that in your contract, but you need to make sure that you say specifically there's been no value given for it. Got a good question from Margarita. If one spouse is under the age requirement, can they be added on later once they reach that age? Yes, through a refinance only. So it cannot be done on the existing loan. You would need to refinance that client and add that borrower at that time. And I suggest doing that. Any non-borrowing spouses I have, I always say that's the plan because it's just going to make their life easier and simpler than the non-borrowing spouse deferral process would be. All right. This is Sam and June. Names have been changed. Fake picture, obviously. But Sam and June wanted to just refi. They came to me because they looked to their finances and said, okay, we got to do this reverse mortgage thing. We don't really want to, but Sam was diagnosed with a heart condition. And when I talked to them, what I discovered was that a refinance wasn't really the right fit for them. Sam had a heart condition. He couldn't go up and down the stairs to his bedroom anymore. So he was living in the den. They put a bed downstairs. They were only like, I think June was younger, but Sam was only like 68, 69. And in good health, other than not being able to climb the stairs or really exacerbate his heart any. And so I said, wait, well, have you guys considered maybe a purchase of a new home instead? And they said, yeah, we looked into that. It doesn't work. And I said, well, the numbers I'm seeing, I think it could work. What would you want to move into? Like stay in your same neighborhood, a similar house? And so we started that conversation. Well, Sam and June ended up selling their existing home and buying a new one that was much better suited for them. The property they had was a 2-story. The property they have now is a single story, but they didn't really, it wasn't a financial decision. So this is an interesting case. The home they sold was worth $800,000. They netted $450 after paying off the mortgage and having some closing costs. So $450 was not going to help buy them a home similar to what they'd had been in. And so that's why they said, oh no, we looked into that and we're not interested. Well, with the reverse purchase, suddenly it became an option. So Sam and June bought a home in their same neighborhood. It was a very similar home for about the same price. They put $400,000 down. They kept $50,000 as a nice little bonus. And they bought the single story in their same neighborhood still for about $800,000. So they moved laterally. It wasn't a downsize. And that's a big misconception. People that are younger than retirement age often think, oh, it'll be so easy. They should just downsize. Well, when you're at retirement, you've worked really hard for all of your lifestyle and all the things you have in your home, and it seems daunting and just unappealing to downsize. And so being able to help people move laterally into a better fit home where there wasn't enough equity to do it if any other option, this is where that option comes from. All right. If you can zoom in, these numbers are small, but I want to dispel any myths about equity being gone. So this is Sam and June's purchase. We have an $800,000 purchase price. Oops, I can't click on my screen. Sorry, guys. All right, $800,000 purchase price. At that point in time, their interest rate was 5.18. The youngest borrower was, okay, she was 75. The expected interest we have to use on these projections is 4%. FHA dictates that's the national average of appreciation long-term. But in San Diego, our appreciation is much higher than that. So while these numbers look good, they're actually even better in real life. So what we're seeing here, this is our amortization schedule, and I present off of this to every client. I'm not going to present the entire thing because we're getting close on time, but I'm going to give you guys a couple of examples. So this projects out what happens to the interest, the loan balance, the property value, and the equity over time. So if you look at year 5, let's say Sam and June decide, this home just isn't right for us anymore. For whatever reason, they want to sell and move. They can. There's no prepayment penalties. And if they did, you can see their equity has actually been increasing the whole time, even with them not making a mortgage payment. You can see we start in year 1 with equity of 420. By year 5, it's 457. Now, in reality, their equity is closer to like 550 because it's San Diego, and we've had a really long run of really high appreciation. But even if it wasn't in that high appreciation, the numbers still look great, right? Assuming they've never made a mortgage payment, they would simply sell for the 973, pay off the mortgage of 516, and receive the rest of the proceeds of 457, less any cost of sale. So that is a really nice way to be able to balance what they need now, what they need through retirement, which in this case was just no mortgage payment. And at the end of the loan, are they still going to have equity if they sell, if they leave it to their kids? Yes, they are. Go a little further out, year 10, same situation. Their equity has continued to increase. Now we're at 500,000. Year 20, you can see 545, year 25, 529. So this is a really, really good, simple illustration, because what I want you to see here is we've maxed out what can be done with the loan amount. I'm not showing you some tiny little loan amount that's not realistic. I'm showing you a purchase which has maxed out their entire loan amount at day 1. So they're accruing interest on this whole amount from day 1. And even still, the numbers look really good. And so when you talk to people about leaving equity for their heirs, if their equity is enough today, then it will likely be enough whenever they pass away, leaving it to their heirs. Aside from that, a couple of crazy situations where interest rates go nuts if they're on an adjustable and the cap is high. Now, personally, I only do a 5-point cap because of that, so it protects them that way as well. And then the situation where somebody just lives forever. You can imagine, look at this loan balance. If someone lived to be 110, 120, the loan balance will continue to increase. And while that property value is projected to increase too, what if they passed away during a down market? Well, that's when the FHA non-recourse insurance comes to protect the rest of their estate. So They've not been making a mortgage payment for 25 years. What have they been doing with that money? There's studies out there that actually show using a reverse mortgage in conjunction with your other assets, starting from a younger age in retirement, means you'll be able to leave more to your kids. And it's been proven. There's studies out there showing it. It's just not known about yet. So that's my job. Educate you guys, and you guys take this to your clients. All right, no new questions. Now, prepare your clients. When you talk about reverse purchase loan, you want to make sure they get a full pre-approval before listing that house. FHA and the other reverse mortgage products, there's some weird things that you need to check out to make sure that it's going to work before letting them sell their home. And then, maybe they can't purchase because we didn't pre-approve them. So just like anyone else, it's just, to me, it's more important because these are seniors and this is a huge life event. Any sale and purchase is, but in the retirement years, it's just a lot more daunting. So you want to make sure you're protecting them. Counseling, get them to counseling. Counseling certificates are good for 6 months. So if you know that they're going to be buying within the next 6 months, get them to counseling now, or have your lender that you're working with make sure they get counseling now so that doesn't delay the process once you're in escrow. Don't let someone sell before they can be sure they can buy again. No seller concessions. You should use title and escrow that specializes in reverse. Now, I know a lot of you don't have that option if the seller is choosing title and escrow, but I highly recommend you have a discussion about that and let them know that if their title and escrow says they can do a reverse purchase, but they're not actually good at it or experienced, then you may have a delay of closing for up to a month while people figure out what they're doing. The truth is there are title and escrow companies that don't even have the software to do reverse purchase numbers anymore. We still use HUDs. We're non-TRID. We don't use LEs. We don't use CDs. So if you're getting on a purchase, don't call your lender and say, hey, did the CD go out? Because there is no CD. No lender credits allowed on a purchase, although on a refinance you could, and we do often. Gift funds are okay. How does the reverse purchase loan help you? Again, you're going to be able to sell more homes. This is a niche product people don't know about. They don't talk about. You're going to make yourself special. Anytime you mention the word new, and you can kind of consider this new in the mortgage arena, most of our loans have been around for decades. The reverse purchase has not been around for more than 1 decade. It's not very old. So you can still kind of say it's a new option compared to like a VA loan or a conventional, which was, done decades and decades ago. You can meet the needs of your older homeowners as sellers and buyers. This is non-TRID. We have no CD, we have no LE. You will see a GFE that is quite confusing. So get with your lender because the GFE doesn't accurately represent the reverse numbers. A different page does. The GFE is, they just kind of force some of the reverse numbers that we use into it, and it doesn't paint a clear picture, in my opinion. All right, stay in the conversation. We have 2 resources for you. If you're a loan officer, I run a loan officer training group. Please find us on Facebook, join that group. It's Christine, just search my name in the groups, Christina.Harmes, reverse mortgage reverse mortgage training for loan officers. And then for you realtors, we have a separate community. This is for realtors, financial professionals, and consumers to learn about the loan. It's not learning how to do the loan and the intricacies of the details of it. This is where you can get all of your questions answered. This is where you can post. This is where you may connect with other consumers to represent them on purchases in your market. That is Reverse Mortgage 101. Please join. It's a place to get your questions answered and a community. It's really hard to find clear information about reverse out there, and we are providing that as best as we can. Personally, I'm with Reverse Loan Solutions. Here's my contact info and all of the disclosure. And we're going to get to questions. I see one that I will answer now. Brandy asks, will the seminar be offered again or recorded? I have about 10 realtors who need to see this, and it's a great seminar. Thanks, Brandy. Cher, I think you are recording it, right?
Yes, we are recording, and as long as you're okay with it, I've received several requests for the presentation that you used today in class, and I'll be happy to send that out with the recording this afternoon.
Awesome. Thank you for that. That's great. All right. Nestor asks, after 5 years, can they sell and purchase again with another reverse? Sure. Yeah, you can only have one reverse out at a time. So the way you typically would do that is a concurrent closing, or try to space a couple of days. You close the reverse they had, and then you open the new one with the purchase. I've actually done one of those. It's fantastic. And people, again, 93% approval rating. People who have reverse, they want another one if they're moving. They like them. All right, Art. So the HECM borrower cannot access the new construction incentives. I believe you're talking about when you do financing with a lender, they offer incentives, and most lender financing, or excuse me, builder new construction financing, they don't offer reverse mortgages. So you're not typically incentivized with them, although you could probably work something out if the builder is open and really understands how this works and the power behind it. I bet you could probably work something out. So that'd be a great thing to do. Recording. This is non-taxable to the borrower. So when we say non-taxable, we want to be careful. The reverse mortgage proceeds are not considered taxable for income purposes, but there are still property taxes. So when we just talk about tax-free, we have to be very careful when we talk about it, because if they're doing a reverse refinance and getting equity, well, that equity is not income. In this purchase, you may have some taxable events going on with the sale and the purchase. So just be careful and direct them to their CPA to get clear advice on this. That's protect your licenses, get them to their CPA. All right, what other questions do we have today?
I just wanted to let everyone know that if you are a guest and you're joining us today, but you're not a coaching student, yes, you will receive a copy of the recording along with the presentation as well. This is our gift to you. We appreciate you attending today's class. If you do have a question and you'd like to unmute yourself, please go ahead and do so at this time. You don't have to put it in the chat. So please feel free to just unmute and ask a question if you have one.
Well, heck, I'll take that as a sign that we went over everything thoroughly.
It was a great presentation.
Thank you.
Thanks, Ken. Awesome. I know I enjoyed your presentation, and I learned a ton this afternoon as well. So thank you so much. I appreciate that.
Absolutely. Go spread the word. This is an unknown about product and people need to know about it. It's so powerful. Thank you for having me on.
Yes, and please join the—
I have a quick question.
Oh yeah, absolutely.
So I was always under the understanding that a reverse mortgage paid you, but the way you explained it, it's just even, like nobody pays anybody. It's just.
Yeah, so great question. Reverse mortgages are really flexible. So you can do that option if it's a refinance where they're not moving to a new home, they just have a lot of equity and they want to access some of that. You can structure it so they receive a monthly payment. You can also structure it so they have a large growing line of credit. You can also structure it so that they're getting monthly payments to them for a certain number of years. And you can also structure it that they're getting a lump sum all at once. And in this case, we're talking about purchases. So in a purchase, all of the loan amount that's available is being used for the purchase. If on a refinance, there's loan amount that's available, that's where you can use that to create a payment to them. So on most of your purchases, you're not going to be structuring any sort of payment to them or the line of credit, but you can. Sometimes we do a line of credit purchase. It's just more rare. They have to bring in more money to do it.
Anyone else? Don't forget, please make sure that you also go to both of Christina's Facebook pages and become a part of those communities as well. Great social media opportunities there, and just learning and being part of new communities with any questions that you may have. So please take advantage of that. Again, that will also be in the presentation that we'll send out to you this afternoon. So if you don't get to write it down fast enough, you will get a copy of that. I think, is that a new question right there?
It is, and I love it. From Nestor?
Yes, and then there's one from Suzanne. Hi, Suzanne.
Yeah. I've got to get going soon, so I'm going to answer these quick and then we got to jump. But Nestor asks, will a reverse impact their DTI for an investment home? It will, in a really good way, right? Because their DTI if they had a regular mortgage, would include that mortgage payment. But if you have a reverse, or maybe you're trying to help them buy an investment home, but their DTI is too high, to have them do a reverse refi on that primary residence. So suddenly now they don't have a mortgage payment included in their DTI. You're still going to have to include their property taxes, insurance, any other property charges, but that can have a really good impact on it. All right, Suzanne, is the previous presentation on reverse mortgages available? I think, Cher, you've probably got that somewhere.
Yeah, and I told her I will send that to her.
Okay, very cool.
Awesome. Well, thank you so much, Christina, for being with us today. We do appreciate your time that you spend with us always so much. I just wanted to thank everybody who joined us today for the first time. We appreciated having you. Really quick, I just want to let you know that next month's class is with Frank Ferens from EPM, and he will be discussing, he's saying, let's chat realtors, what's going on in today's market, and that will be August 24th at 2 p.m. Eastern time. So that information will be put out on our social media sites, and we'll send that out. So these are for sharing classes. We do encourage our students to invite their realtors and business partners, and we do also invite those on our social media platforms to come and join us as well, who've never come and joined one of our live classes. But again, thank you so much, Christina. I thank all of you for attending today, and we hope to see you again next month.
Thank you so much, Cher.
Absolutely. Thank you, guys. I hope you enjoy the rest of your day.